Welcome back to Investing Talk Podcast.
Today, we are looking at a company that is, well, arguably the most important bridge between the old world of finance and the new. It's Coinbase. And frankly, if you've seen the headlines from their Q4 2025 earnings, you might be wondering if that bridge is starting to crack.
It's a pivotal moment, no doubt about it. The numbers just dropped, the stock took a huge hit, and the whole story just feels messy.
It really is.
You've got revenue down, and I mean down significantly, yet their margins are shockingly high. It's a real conflict that makes you ask, is this a falling knife you just let drop? Or is this a rare entry point into what could be a future financial giant?
That is the multi-billion-dollar question, isn't it? The market's reaction, it looks like panic. But the internal strategy suggests something very different is brewing under the surface.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps the algorithm know that you want more of these deep dives.
It makes a huge difference for us. Thanks, everyone.
All right, let's get into the weeds. Segment 1, the fundamentals. And, we have to start with the ugly stuff because there is no way to sugarcoat this Q4 report.
No, it was definitely a cold splash of water for investors.
I was looking at those top-line numbers, and the drop is just stark. They reported revenue of $1.78 billion.
Right.
Now, on its own, a billion-plus quarter sounds okay, but you have to put that in context. Year over year, that is a 21.6% decline.
A fifth of their business. Just gone compared to last year.
Exactly. And that's what spooked the market. Investors hate a shrinking pie.
And to make it worse, they missed the consensus estimates. Wall Street was modeling for, $1.79 to $1.83 billion? So they didn't just slide. They came in under the floor of what everyone was expecting.
The earnings per share, the non-GAAP EPS, that was even rougher compared to expectations. They posted $0.66. The street was looking for something closer to 90 cents.
So that's a miss of roughly 30%. Ouch.
Yeah. If I'm a pure fundamental investor looking at growth, this looks like a company in retreat. The revenue trajectory is undeniably down right now.
And if you only look at that top line, I would totally agree with you. It looks like a growth story that has just hit a brick wall. But this is why we do this. We have to look past the headline because while revenue is down, something else is happening inside the business that is just fascinating.
You talking about the margins?
I am. Despite revenue dropping over 20%, their gross margins are sitting near 85%.
85%. That is an absurd number.
It is.
For anyone listening who doesn't spend their day staring at balance sheets, let's just clarify what that means. 85% gross margin is software territory.
Right. That's usually reserved for companies that sell pure code SaaS businesses where selling one more copy costs basically zero.
But Coinbase is doing that in a trading environment.
Exactly. And it gets better. Their EBIT margins, that's earnings before interest and taxes, are at 30%.
So this brings up the idea of operating leverage. I want to unpack this because it's so key to the bull case here.
Please do.
Operating leverage basically means your costs are fixed. It costs Coinbase roughly the same amount to run their servers and compliance teams, whether Bitcoin is at $40,000 or $100,000.
So when they make money, they keep most of it.
But right now, we're seeing the flip side of that, aren't we?
We are. The revenue is down because of lower asset prices and fee compression. But because they're so disciplined with costs, they are still printing cash. They are a cash-generating machine, even in what looks like a bad quarter.
And I saw this weird anomaly in the report. They listed record trading volumes under their operational growth. How can you have record volume but revenue down 21%?
That's the divergence. Activity is high, people are trading, but they're trading in a market where asset prices were lower in Q4 and fees are getting squeezed. That's like a grocery store selling more items than ever, but everyone is just buying the discount brand. The engine is running hot, but the fuel was cheaper.
Which leads us to the pivot. I mean, Coinbase knows they can't just rely on trading fees forever. It's way too volatile.
If the market crashes, their revenue crashes. Simple as that.
So reading through their 2026 strategy, they're talking about this thing called the everything exchange.
This is the critical shift. For the last decade, Coinbase was the crypto place. Management has realized that's just not enough anymore. They want to be the financial place.
The docs mentioned expanding into on-chain equities, prediction markets, and scaling stablecoins. Let's break that down. Prediction markets, that's like betting on election outcomes or sports, right?
Exactly. Think poly market. It's a massive, high-volume market that's really fragmented right now. Coinbase wants to bring that in-house, and then there are stablecoins.
The boring but profitable part.
Right. They earn interest on the reserves backing those coins. It's steady, predictable income that doesn't care if Bitcoin goes up or down.
And on-chain equities just sounds like the holy grail. I mean, imagine trading Apple stock, tokenized, on the blockchain, 200 to 47, with instant settlement.
No more waiting for the NYSE to open at 9:30 a.m. That's the vision. They're targeting a 12% compound annual growth rate for revenue over the next 2 years, and it's all driven by this diversification. They're trying to smooth out that roller coaster.
But to pull any of that off, you need trust. It can't be some cowboy exchange.
Yeah.
And that brings us to their HOT.
Mm-hmm.
I think a lot of retail investors miss this. Coinbase isn't just an app on your phone, it's the plumbing for the big guys.
That's the compliance moat. We aren't just talking about users like you and me. We're talking about the fact that 5 of the top 20 global banks use Coinbase for their crypto infrastructure.
And the BlackRock partnership. I feel like people just gloss over this.
They do. BlackRock isn't just partners with them for a press release. Coinbase is a custodian for the Bitcoin in BlackRock's ETFs.
Right. When the largest asset manager in the world needs a vault for billions of dollars in crypto, they don't build it themselves.
They hire Coinbase. And that integration creates massive switching costs. You don't just move $10 billion to a different wallet on a Tuesday afternoon. Once BlackRock is plugged in, they are staying plugged in.
So even if the retail trader leaves for a cheaper platform, the institutional money is bolted to the floor at Coinbase.
That's the whole argument. The retail app is the tip of the iceberg. The institutional infrastructure is the rest of the ice.
Okay, that's the business, reality efficient, pivoting, and entrenched. But the market doesn't seem to care about any of that right now. It just sees a missed target and punishes it. We have to bridge that gap. So let's talk technicals. The price action has been brutal, hasn't it?
It has been a very rough ride. Following the earnings news, the shares slid 13%. We're trading at, roughly around $146 right now.
And just to put that in context for everyone, the 52-week high was $444.65.
Wow.
We are talking about a stock that has lost 2/3 of its value from the peak. That feels like a crash.
It certainly feels like one. If you bought at the top, you are definitely hurting.
But, and there was always a but, with these high beta stocks, if we zoom out, the picture changes a bit. What's the yearly view look like?
Despite this recent crash, the total return over the last 12 months is still positive 47%.
That is just wild. So even after dropping 13% in one day and being way off the high, long-term holders are still up nearly 50%.
And that's why we call this a psychological pullback. The drop to $146 looks terrifying on a daily chart, but on a yearly chart, it just looks like a healthy correction and a massive uptrend. The underlying momentum has been incredibly resilient.
Okay, let's talk about volatility and flows. The options market is pricing in some wide moves. This stock does not sit still.
No, it's a high volatility asset. And crucially, the flows are still tied to Bitcoin. We have to be honest about that.
Sure.
The correlation is high. If Bitcoin rallies, Coinbase rallies. If Bitcoin dumps, Coinbase dumps. The everything exchange strategy is trying to break that correlation, but for now, they are still dancing to the same tune.
So it was $146 a floor. Some analysts seem to be framing this as a specific entry opportunity.
Well, if you believe that diversification story holds, that they will successfully launch these prediction markets and on-chain equities, then yes, $146 is a discount. You're buying the future infrastructure at today's panic prices.
Which transitions us perfectly to the market mood. So let's move to segment 3, sentiment. How is the street actually feeling about this? Is it all doom and gloom?
It's shockingly split, actually. The quantitative sentiment score, which measures the tone of news and reports, is sitting at a neutral 0.
A flat 0. So that basically means the good news and the bad news are perfectly canceling each other out.
Exactly. The bad is the Q4 miss on revenue and EPS. The good is the operational story and the strategy. The algorithms just don't know which side to pick.
But the humans are picking sides. I'm looking at the analyst actions, and there's a real standout here from Goldman Sachs.
Goldman upgraded them back in January, and this is key. They didn't upgrade them based on Q4 earnings. They upgraded them based on strengthening fundamentals and that product expansion.
So Goldman is looking at the windshield, not the rearview mirror. They see the pivot coming.
And look at the price targets. The average price target on the street is approximately $335.
Okay, let's just do the math on that.
Sure.
We're trading at $146. The target is $335.
Yep.
That is more than 100% upside. That implies the stock could more than double if the analysts are right.
It's a massive gap between the current price and the perceived value.
And while we don't have filings showing insiders buying right this second, that institutional interest we talked about, the banks, BlackRock, that serves as a proxy for smart money, doesn't it?
I think so. They aren't buying shares, they are buying the service, which is arguably more important. It verifies the utility of the company. It's not a meme stock, it's infrastructure.
However, we are not here to pump a stock.
Uh-huh.
We're here to analyze it, and that means we need to look at the dark side. So let's go to segment 4, the bear case. What could kill this company?
There are two major risks that could keep Coinbase pinned at $146 or, send it even lower. The first, which we've touched on, is that revenue volatility.
We just can't ignore that 21.6% decline. It's the elephant in the room.
It is. The skepticism is that the business is still way too tied to the crypto slump. If we enter a prolonged crypto winter, where prices just go sideways for 2 years, Coinbase's revenue will continue to bleed.
The everything exchange is a great idea, but it's not fully built yet.
Not yet. Today, they need crypto people to trade crypto. If that stops, the business hurts. Badly.
So if you think crypto is a fad or is going to zero, this is just uninvestable.
Correct.
And then there's the second risk, the one that keeps every crypto CEO up at night: regulation.
Legislation is cited in all the reports as the next big obstacle. We are still waiting for clear regulatory frameworks here in the U.S.
And uncertainty is the market's worst enemy. If the SEC or Congress decides to crack down on stablecoins or ban prediction markets, that entire growth strategy we just praised goes up in smoke.
It's a very valid fear. A stroke of a pen in Washington could handicap their entire growth engine.
However, I've heard a counterargument to this. And it goes back to that moat concept. Isn't there a world where regulation actually helps Coinbase?
That is the sophisticated take, and I think it holds water. Think about it. Bank CEOs view crypto as an existential priority.
Right.
They need to be in this space to compete, but they cannot afford to partner with some shady offshore exchange. They need a partner that is compliant, audited, and regulated.
So if regulations get tighter, it wipes out the Binances of the world or the smaller players who can't afford the compliance costs.
Exactly. It raises the barrier to entry. Coinbase has spent years and millions of dollars on lawyers and compliance. If the rules get stricter, their compliance moat just gets wider. They become the only game in town for institutional money.
So regulation might kill the competition, leaving Coinbase with a monopoly on all the legitimate flows.
That's the bull case.
Look.
And on the volatility risk, that's exactly why they're pushing into stablecoins. They know they have a revenue swing issue, and they're actively building the fix.
So we've unpacked the ugly earnings, the stellar margins, the ambitious strategy, and this regulatory tug-of-war. It's time to bring this in for a landing. Segment 5. The verdict.
Yeah, when you weigh all the risks against the potential, a pretty clear picture starts to form.
So what's the score?
I'm giving this a bullish score of 7 out of 10.
7 out of 10. That's a strong rating,
Yeah.
especially considering that big revenue miss. Walk me through the final thesis here.
The elevator pitch is simple. Coinbase is a margin monster. You just don't ignore a company with 85% gross margins. And they are building the actual infrastructure for the future of finance tokenization, payments, banking.
So you view the current price action as just noise.
I view the drop to $146 as a cyclical dip in a secular growth story. It has a massive moat. The market is punishing them for a bad quarter in a volatile industry, but I think the smart money is looking at the plumbing they're building for the next decade.
This definitely sounds like a multi-year hold, not a quick trade.
It is. This is a play into the 2026 catalysts. You hold this while you wait for that strategy to mature.
Speaking of catalysts, for the listeners watching this stock, what should they be looking for in the next, say, 3 months?
Okay, first, watch for the Q1 2026 earnings in late May. We need to see if revenue stabilizes. Second, watch for any news from Washington on crypto regulation. Any clarity is bullish. And third, keep an eye on macro factors. If interest rates shift or Bitcoin rebounds, Coinbase acts like a levered bet on the whole sector. It will move fast.
And with that average analyst target at $335, the implied upside is roughly 2x from here. That's a risk-reward ratio that a lot of investors are going to find very tempting.
It's high risk for sure, but the reward is clearly defined.
Coinbase is down, but based on the plumbing they're building, they are definitely not out. They're trying to evolve from a crypto exchange into the backbone of modern finance.
And if they pull it off, $146 is going to look like a gift.
But as we always say, the future is never guaranteed.
Always do your own research.
That's it for this look at Coinbase. We hope this helped you make sense of all the mixed signals in the market. Is it a falling knife or a golden opportunity? Let us know what you think in the comments below. And don't forget to subscribe so you don't miss our next breakdown.
Thanks for listening, everyone.
We'll catch you on the next one.